Welcome to Stocks in Translation, Yahoo Finance's video podcast that cuts through the market mayhem and noisy numbers to give you the information you need to make the right trade for your portfolio. I'm your host, Allie Canal, in for Jared Blickery, and with me today is the fabulous Sydnee Freed, aka the voice of the people. Kindly like, subscribe, and comment on Stocks in Translation on Spotify, Apple Music, Amazon, or YouTube. Kicking off today's show with our phrase of the day, which is retail investors, otherwise known as non-professional traders who buy and sell securities, ETFs, or mutual funds for their own personal accounts. And our number of the day, 4 trillion. That's the milestone Nvidia just hit in market cap, becoming the first publicly traded company ever to reach that level. Retail traders love this name, but the big question now, is it sustainable? To help break this down and so much more is Ryan Detrick. He's the chief market strategist at the Carson Group. Welcome back to Stocks in Translation, Ryan. It's so nice to have you.
It's been a while.
It's been a while.
But I'm excited to be here. We were talking, I was here last August, and that was the yen carry trade. A lot. It was hot in your city back then. A lot different. Now we've got markets up a lot, little better things to talk about.
Look at everything that's happened in a year. And I want to start there because we have stocks at record highs. Yeah. We have a lot of trade developments that continue to come out over the past couple of days. I'm sure there's more to come there. I know you're bullish, but is there anything out there that concerns you?
Sure. I mean, the obvious ones are, yes, if there's some wild thing with trade, that can upset the apple cart. Really, when you look at yesterday's numbers, they were saying, some of the tariffs are about the same as what we heard back on Liberation Day, and the market took in stride. So I think it's probably taco once again is what the market's saying. But the one thing that maybe worries us a little bit here, we are bullish overall, we can get into that. What if the Fed doesn't cut? Or, we don't think they will. I mean, I know that's not the base case. The market, Fed Fund Future says 2 cuts. We're looking at things, the economy to us is pretty good shape. Could they cut? Sure. Wages are 3.1% year over year. They were 3.1% back in 2019. We had Fed funds back then 1.5%. Now it's 4.5%. So you could argue the Fed should be cutting. And honestly, we thought they should have been cutting earlier this year. And they said because of tariffs, they didn't. But we think that there's possibility that maybe they don't cut, and maybe the market doesn't like that much.
I mean, President Trump is certainly not going to like that. He posted on True Social today calling for 300 basis points worth of cuts.
Okay.
So you were just talking about how there are reasons to cut, there's reasons not to cut. And when we think about the good cut versus bad cut debate, if we see cuts down the line for bad news, whether it be a deterioration in growth, the labor market, how do you think markets will react? Do you think they'll rise because we're finally getting these cuts? Or is that actually maybe a near-term risk?
I think near-term risk is probably a better way to put it because, again, the economy's slowing. Earnings have been strong. Forward S&P guidance for 12 months on S&P 500 earnings, it's at 281, I believe, just on Friday. That's an all-time high, right? Profit margins this cycle hitting new highs. There are some positive things, but if it's because the economy's slowing, then, that's a worry. And clearly, we all know this. Every guest has probably mentioned this. The housing market. I mean, the housing market is really, really struggling because of what's going on with simply the higher interest rates. So if they were to cut 300 basis points and make President Trump happy, that'll also make the housing market awfully happy. But again, it's not our base case. We don't see a recession, but those are things that kind of, I don't want to say keep us up at night, but the things we think about, I guess, when we're talking about constructing a portfolio to be kind of ready for what do we not know, what could mess this bullish thesis up. And again, maybe, no cuts and a little stronger economy could do it, actually.
So we're at record highs. You're a bull. Yeah. How does a bull prepare for a possible downside risk? Like, are there any mitigation efforts you're thinking of?
Sure. So we manage almost $5 billion on the Carson team for our advisors. And we use a phrase this year a lot. When in doubt, diversify it out, right? So when I came on Yahoo and with you guys last August and many times last several years, we were very bullish in 23 and 24. It wasn't popular. People didn't like that. We were in the U.S. pretty heavy. On March 3rd, we actually we're still over at equities, yes, but we actually took out some of our U.S. exposure, went into developed international. So we're more even weight U.S. and developed international here. So that's one way that, maybe that's a big question we were talking about before we went live. For 6 months, Europe's done great. We've seen this before. Is this Lucy in the football, pull it back, Charlie Brown misses again, or can it continue? Honestly, we think this strength that we're seeing in developed international, Europe, maybe Japan starts to play along the second half of the year, that can continue, and that's one way we're kind of, potentially protecting ourselves if there's trouble in the U.S. We think the rest of the world's going to do pretty good. Last comment, what happened this year, right? I mean, most global markets are up double digits. Most in Europe are up 20% or more. U.S. up, 5, 6, 7%, depending on how you're looking at it. And it's lagged, but after 2 years of leading, we think it's perfectly normal. We are optimistic the second half of this year, U.S. is going to kind of take the lead back. But the rest of the globe should do pretty well, too.
And that's something we've been hearing from a few strategists, even on this program, how there are opportunities overseas. When it comes to the S&P 500, where do you see that index ending the year? And recently we saw upgrades to the forecast from Bank of America, Goldman Sachs, but Bank of America just sees very limited upside, around 6,300. And they say that there aren't any near-term catalysts. So what's your call and what catalyst do you see?
Yeah, we came into this year thinking the S&P 500 would gain between 12 and 15%. The day people listen to this and this comes out, our mid-year outlook's coming out, we've left it there. Now, I want to be very clear. We didn't cut our guidance. We didn't remove our overweight to equities, the money we run back in early April when everybody else was. We thought it didn't make sense. We looked at the credit markets. We looked at the economy. We thought we'd snap back. No, I didn't think we'd snap back this far or this quickly. Not complaining. So we are still overweight. So we still think there's some upside to this. One little, I'm known for these little stats and things. We're calling this the sweet spot, right? Someone plays golf. When you hit the ball in the sweet spot, it just feels perfect. The market, when you look at the S&P 500 at the middle of the year, and it's up between 5 and 10%. So a good year, but not a bad year. Some of the worst second halves ever have taken place after the worst first halves ever, like 2022, 2008. Some other examples. 87, market's up a ton. Some other years, market's up a ton. And then the second half wasn't that good. So this is kind of like, not too hot, not too cold. When you're up between 5 to 10% middle of the year, like we are right now, the rest of the year has been higher, 13 out of 15 times for the S&P, and slightly above average returns. One more on this. When you're up in May and June on the S&P 500, like we were this year, those normally aren't that strong a month, to be honest, but they were this year. The rest of the year has been higher, 15 out of 16 times. These are just two examples, I'm aware, but when you stack these on top of each other, I'm a message of the markets, type of market strategist. What's the market telling us? To me, it's still telling us it likely wants to go higher the second half of this year.
So you're seeing you want between 12 and 15% by the end of the year.
I want 30%.
Okay, well, I want 100%. I think when I checked this morning, S&P was a 6% gain so far year to date. So what gets us the rest of the way? Is it still AI optimism, big tech overall? What is it?
Yeah, I think it's just continuation that the economy is stronger than people give it credit for. I think really, earnings, we're going to have earnings season starting next week, right? I think it's going to come in better than expected again. The consumer, there's so much worry about the consumer, and there are clearly cracks. We've seen a little bit of a jump in initial jobless claims. We know consumer confidence has been low. It's been low for 3 years, though. But then you look at what people are doing. They're still spending money. The labor market is still averaging 150,000 jobs the last 3 months. The unemployment rate did just tick lower. So we're optimistic that the economy can hang in there, and that can continue to justify where we are with this global bull market. And then I say I'm not the smartest person in the room by any means. I think the credit markets are. The credit markets continue to show very little worry about the economy. Back in April 8th and 9th, when the world was ending and everyone said how bad it was going to be, the credit markets were not freaking out back then. And that's something we stressed then. So the credit markets are still calm. Earnings are strong. Profit margins are solid. Those are things, again, that suggest to us that there's still good amount of upside the second half of this year.
Now, we haven't had tariffs hit the consumer quite yet. And there's a variety of reasons for that. We had front loading, delayed implementation, et cetera. But we have heard from economists who say that we should see that impact in the second half of the year, maybe even into 2026. So what do you say when it comes to that and the cracks that could form down the horizon? Are you taking this approach of let's just wait and see?
I guess technically we are. I mean, we have a diversified portfolio. We have some bonds. We have some gold. We have some managed futures. So if things really get bad, hopefully those other parts hang in there for the portfolio. But you talk about inflation. I mean, our tariffs are a tax. We know that. And they're probably a one-time jump in pricing. We know that. But at the same time, you think about it, what's the other part of inflation that's really improving right now? Well, shelter, right? Shelter has been this big part of inflation that's been stubbornly high. The last 2 months, shelter's been improving. So I guess you could say I'm glass half full type of mentality, but maybe you got shelter and rent prices starting to come down. Maybe some of these other prices go up and they, in a way, offset themselves. I mean, Jerome Powell himself has said, 2 weeks ago, I believe 2 weeks ago was today, I would have cut 2 times if it wasn't for the tariffs. I mean, we know that. This is his legacy, right? He's done in May of next year. Well, I guess he can stay on at the Fed, but he's not the main guy at the Fed anymore. And the reality is he doesn't want inflation to come soaring back because it's not going to look good because, honestly, he was kind of late the first time, raising rates. Now, honestly, I think he's probably been late this time. He probably should have been cutting early this year. He didn't. But those are kind of some of the things we see there.
Well, the Fed always says they're data dependent. If they're saying that they're not because of tariffs, but the data is good, what's that argument?
Well, they're not supposed to be political either. And obviously, after November, they fully aware of some of President Trump's obviously things he ran on, specifically the one big beautiful bill, which we just had. They know that was going to increase spending, that potentially is going to keep interest rates higher. That's something, again, that is just being priced in, I guess we'll say, but also why we remain overweight equities relative to bonds, because we wouldn't be surprised if interest rates stayed a little bit higher here with all the spending. I mean, deficits are a dirty word, I guess it feels like when you point it out, but at the same time, our deficits as a percent of GDP in the U.S. is about 6.5% right now. Probably going to go to 7.5%, maybe even upwards of 8% if you include interest over the next several years due to the one big beautiful bill. And that is an extremely high amount of deficits relative to GDP in an expansionary environment. I want to be very clear. But the other side of this, you look back in history, when you have big deficits, you know what you also didn't have? Better profits and a strong economy. One quick example on this for the listeners who remember the tech bubble in the early 2000s. When did the market bottom? March of 2003. What happened then? The war in Iraq started. All of a sudden, we started spending a lot of money on that war. Our deficits exploded in 2003, 4, 5, and that actually marked the bottom. So the market sniffed out higher deficits, which I know maybe are higher rates and maybe some problems down the road, but historically, markets do okay with big deficits. So just something to think about.
I'm curious in terms of the markets, like what is the difference between getting no cut this year, getting a 25 basis point cut this year? Like how much does it matter either way?
Yeah, I mean, listen, a 25 basis point, 50 basis point cut probably doesn't matter that much. I mean, like honestly, if the Fed cut 300 basis points and made President Trump happy, he might not be so happy because I bet the economy is not doing very well and we probably are really in pain. So that's where this is interesting. But I mean, to be blunt, we think they should probably cut 50 basis points the rest of this year. We're just not so sure they're going to.
All right. Well, a lot more to discuss, but we're going to take a quick break. We'll be right back. Welcome back to Stocks in Translation. We're here with Ryan Detrick. And Ryan, we were just talking about the Fed, certain risks, catalysts to the market. Certainly one catalyst right now is Nvidia. We have a $4 trillion market cap, a historic moment for the stock market, beating out Microsoft here. Wow. What does this say about where we're at in the AI wars?
Yeah, there's so many ways to look at this. I guess, when was DeepSeek? It was February, right? When all that started and tech just was crushed and everyone said, oh, this is the end. And very few people said maybe not. Our buddy Dan Ives, Dan said no. And now here we are, right? We've come all the way back. So I think it's important to remember that first off. But it's just a reminder. This is like the earlier segment, kind of a global bull market. Well, now, at least in the U.S., we've got a lot of participation, right? Finally, technology's come back. Just last week, we had technology, communication services, industrials, and financials all hit all-time highs, right? That's a broadening bull market. That's a strong sign. So to see Nvidia doing what it's doing, bringing tech along with it, honestly, tech's following along. Those are just signs that this is a healthy bull market. I mean, honestly, the first 6 months this year, tech didn't do well. Now, we know that. Relative, it didn't. It did great for 2 years. Maybe that's just how it goes. We're more neutral technology. We obviously have a lot of it in the portfolios we run because tech's such a large part of the market. So if it does well, we're not going to complain. But it is pricier, quote unquote, because that's where the earnings growth is coming from. So that's where the risks are a little bit higher. But honestly, to see Nvidia doing this, it's a great sign, and hopefully a sign this global bull market and broad-based bull market is alive and well.
What does this milestone mean to an Nvidia investor, though? Like, should they double down right now? Do you sell high? Like, I know you're not going to say to sell necessarily for bulls, but what do you do with this information? Or is it just something you say, congrats, $4 trillion?
Yeah, I'm not going to say double down either. No, I think I have to be... I can't give individual equity advice. We'll just say broadly, if you had a stock that was $4 trillion broadly, not named Nvidia. The truth is, again, maybe to ring the cash register a little bit. There's nothing wrong with that, right? I mean, people have made incredible amounts of money. There are some underloved, underappreciated areas. Honestly, I think financials. I mean, financials hit all-time highs. No one's talking about it. I don't think. I mean, banks had an incredible earnings season 3 months ago. We'll see what they have to say this recent earnings season. So we call it, the shiny object. Don't chase. I work with clients all the time. They always want to be in the hottest thing. They always want to be in the strongest thing. And you can have some exposure to that, don't get me wrong. But again, who in the world 7 months ago said at the beginning or at the middle of the year, developed international EFA would be up like over, ballpark 20%. I don't think anybody had that on their bingo card. So again, it's important to stay diversified, continue to not chase that shiny object. Right now, Nvidia is a shiny object, but if you've been in it for a while, congratulations.
And chasing shiny objects, I feel like that's the MO of retail investors. So far this year, we seem to be in this FOMO-driven rally, this momentum-driven rally. But at the same time, as you were mentioning, we have seen this broadening out. Are there any concerns when you look at market frothiness, risks or speculative trades, or do we think we're at a solid point?
Yeah, well, I think we're at a solid point. I mean, I travel the country, get to talk to people all the time. I never present for a room full of people. I never have someone say, hey, this is really good out there. How high can it go? I've never gotten that question lately. It's usually what can go wrong. But there are some. I know the AAII sentiment poll had the most bulls recently all year. Let's see, the NAAIM, which I always forget what that stands for, but it's active managers. It's up over 100. That's about the highest it's been this year. So you're seeing, now we're not seeing too much froth when it comes to the options markets. We know hedge funds are net short still. I mean, hedge funds are still quite, dour. That Bank of America Global Fund Manager survey recently, so it came out right about a month ago, actually. The most recent one showed the most underweight the big money has been on the U.S. relative to Europe like ever. And how's that treated the last month? So again, it's kind of a mixed bag, and I like that. And honestly, when we look at sentiment and we do the studies on it, sentiment tends to work really well at bottoms, right? You get the extreme negative sentiment. That's where lows come. You can have bulls in a bull market. In fact, you want to have bulls in a bull market. So we're not seeing the over the top stuff that worries us, big picture. But listen, July is up the last 10 years in a row. If it's up this year, that'd be 11. If my math is right, that would tie the all-time record. But as we were talking about before we came on, August, September are out there. For whatever reason, those months always seem to have some little hiccup. I wouldn't be shocked at all if we saw something like that in the coming fall months, which would be perfectly normal after the rally, up 25% approximately off those April 8th lows. That'd be okay.
You don't want to chase shiny objects. You say, how do you find a not shiny
a dull object?
A dull object.
That's still you still want.
That's a winner. That's an undercover winner because everybody wants to find the next Nvidia, right? But maybe let's set our eyes a little lower. Like, what if we just want to find a solid stock? What is your advice?
Yeah, well, listen, I mean, small caps and mid caps, they're fine. I mean, there's not much excitement there. The valuations are historically cheap. And you think about Europe, historically, Europe and small caps and mid caps, they kind of value trade. They've kind of traded together. Well, we know Europe's done great, and we haven't really had the outperformance from small and mid caps. So potentially those can be some areas that not going to who knows? Maybe one of those stocks could afford $1 trillion. I'm not saying that, but just in general, buy a bucket of those ETFs on small or mid caps. Those can be a nice area that are cheap for a reason, but potentially going to be a value down the line.
You think? We've been waiting for small cap. I mean, every year it feels like we're waiting for the small cap rally, and it just hasn't materialized.
Exactly. I want to be clear. We're a little bit underweight small caps relative to large caps. So I'm just giving an example. We do think large caps will still do a little bit better. But I'll tell you, over the last 4 or 5 weeks, small caps have started to do a little better. So it's just little baby steps. And the thing we talked about a little bit ago with the Fed, small caps want small caps want lower interest rates, right? I think they rallied a little bit last week on hopes of that. Then on Friday, it was Thursday, Jobs Thursday.
Right.
It's hard to remember that.
4th of July holiday.
You do something for long enough, you usually call it Jobs Friday. Then they got hit because, now they're punting again on the cut. So those are some things. But again, that's why you keep a diversified portfolio and just, it'll take care of itself, really, if you do it that way.
And we are seeing long-term treasury yields come down from some of those highs in April, which is also a good thing for small caps. But going back to large caps, it's interesting because we have seen some dispersion when it comes to the returns for these mega cap names. So Microsoft, Nvidia, Meta, they've all done really well.
Yes.
Amazon and Apple, not so much. So it feels like, is it a stock picker's market within the Mag 7 right now?
Within the Mag 7, yes. I was going to say it's not so much a stock picker's market when you look at the sectors in general. There's a lot of strength out there. But the Mag 7, it is. And of course, Tesla has been in a lot of trouble for different things going on.
I didn't even mention
I know you didn't mention them. So, but it is from that point of view, I guess. But
is that because of macro headlines? Is that a specific, Apple, specific to each company?
I think it's specific. I mean, Apple, their growth is, I don't know the number off the top of my head, but Apple is really slowing down, right? And Amazon, well, they're still a good company. Every time I walk in my house, I trip over something, so I think they're still doing okay. I know it's Prime Days as we speak. So we'll see how that goes. But the reality, I think that's more company specific. But that's the beauty of that. You can buy a basket of Mag 7, buy them in general, and hopefully over the course of time, maybe a couple lag, but some of the other ones do well.
You've brought up international a few times in our conversation. I'm curious, what is the right allocation to international investments? Let's say for someone who has a long runway.
If you think about 100% basket for stocks, right, as we're doing, we have about 70% U.S., we've got about 20% in developed international, and about 10% in EM. And that's more even weight, if you will, U.S. and international. We're a little bit underweight emerging markets there. So that's kind of how we look at it. Again, we don't necessarily like emerging markets. We think there's still some potential issues with China that are out there, but we still have that exposure and the money that we run because, that it's okay. I mean, it can still do well. So that's how we see it. Now, when it comes to developed international, we do like Europe. And I know, everybody likes Europe now because it's done so well. We were adding European exposure for a pretty big amount back in March because right around February is when Germany came out and said they're really going to start to do some new stimulus things to really get their economy going again, like the largest they've ever done potentially outside of like a real catastrophe. And those are reasons we think those areas are going to continue to do pretty well. And they have, and we think it can continue.
All right, Ryan, and now time for a segment we like to call Lost in Translation, where we get our guests' takes on what the market might be misunderstanding. And something you find people are completely misunderstanding at this current moment is that market highs are not something to fear. Why is that? Make your case.
Yeah, I call it the fear of heights, right? People have all the big skyscrapers in New York. Sometimes you have a fear of heights. When you look since 1990, I found 738 new all-time highs are made on the S&P 500. And if you pick any random day about a year later, the S&P is up about 9%. All right. But after those all-time highs, the S&P is up actually double digits, and it's up a median of 13.5%. And you look at these new highs happen in clusters that last for a while. And yes, then you can have a period like from 2000 to 2013 where you didn't have many. But once you start making them, these clusters can last a lot longer than you think. And if you have reasons to be optimistic, like we talked about during this podcast, if the economy does a little better, the economy does better, earnings do better, maybe the Fed actually cuts a couple times for the right reasons. Simply inflation's coming back down and the economy's okay. Well, those are some of the right reasons to cut. Those all can be reasons this bull market continues and those new highs continue as well.
So moral of the story, if you're not in the market yet, it's still okay to get in at these record highs.
We think so. Now, people always say, let's say you have $1 million. What do I do now? I said, well, that's a tough call. I mean, I always say maybe put 20% in every 6 weeks or so, and over the course, that way you don't, nail a top or you maybe get a pullback. And what Eisenhower said, plans are useless, but planning is everything. The reality is whatever you're going to do, set a plan and make sure you stick with it, because there's nothing worse when the TV is red and everybody on TV is telling you how bad it all is. You're not going to make a good investment decision. That's why you really have to make these decisions very clear cut, write them down and say, I'm going to stick to it and do it. And the reality, again, is this has been a global bull market. I think it's going to continue, and the second half should be pretty good.
Ryan Detrick, thank you so much for joining us today. And we're winding things down here at Stocks in Translation, but make sure you check out our other episodes on the Yahoo Finance site and mobile app. We're also on all of your favorite podcast platforms, so be sure to leave a comment, and subscribe wherever you get your podcasts.